Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It is Monday morning, May 8th, and this is The Talking Point. Thank you so much for joining me on this call. As I record this call, the market has been open a bit. It's still a little bit negative, but mainly flat. There's an awful lot for the market to digest this week in terms of data and also in terms of earnings. But first, let me just recap from what we saw last week and why it's important this week and beyond. Obviously, last week was a major week for so much in terms of the Federal Reserve, in terms of the banks, and in terms of the payroll report. But in terms of the banks, we saw on Friday, we started to see a recovery in those regional banks. We hope that this week it stays intact and we see what we always call follow through. We're always looking for follow through. Also on Friday, we saw that the small caps actually performed well. Keep in mind that throughout the small caps, there are so many small banks included in the small cap space. So that was encouraging that we saw the Russell 2000 perform better than we had seen it in some time. We're going to pay attention to whether or not that can be maintained because, again, this entire crisis with the banks has really affected the small banks and the regional banks. Now, what happened last week in terms of the regional banks is that we started to see a very heavy insider buying. It's not insider trading. I want to make that clear. It was insiders buying the stocks of their own companies, their own banks. And it was forceful. It wasn't just a little bit at the margin. It was heavy buying. And the reason that they gave essentially was, we know the fundamentals. We know the strength of our deposits and so on. And that helped the markets recover. Overall, the general markets, but obviously the regional banks. Again, this week, what we're looking for is that famous headline, follow through. That's what you're always looking to see. Now, the other thing about last week was the Federal Reserve meeting, was it not? And the reason that is so important is that the market is trying to figure out if the Fed is finished raising rates, if that was it. Was it one and done? Now, clearly, the statement did not say it. The statement was clear that the Fed understands the lagged effect of rate hikes. And by the way, I want to say parenthetically, it also happens with rate cuts. It takes a long time before rate cuts work their way throughout every crevice in the broader economy. And that is the way it is with rate hikes. It takes a long time. Now, mention that. They mentioned, again, they called it the cumulative effect of all of those rate hikes and the lagged effect that is in operation that takes a while to see how it unfolds. Also, they wanted to see what happens with lending standards, right? We believe that they have risen. We've heard from small business owners. We've heard from consumers that securing a loan is becoming more difficult. The question is how much more difficult. And this week, by the way, we are going to hear from the Senior Loan Officers Survey. Chairman Powell, I just want to mention, was asked about it. The reason is it's a Fed report in essence. So they received it before the announcement of the statement last week. They knew what it said, and Chairman Powell was asked, well, could you tell us about it? And he said, well, we'll release it next week, and we'll hear about it now. But overall, the market obviously is listening to what the banks have to say, listening to what consumers have to say, small business owners have to say, in terms of actual effect on securing loans. The reason this matters is the more difficult it is to get a loan, you're going to just wait. You're not going to get the loan. You're going to not buy that car. You're not going to buy that equipment. You're going to hold back. And that serves to weaken the economy, right? And the Fed mentioned this. Chairman Powell mentioned we don't know by how much, but we know it does slow down the economy. That's another thing. And then in the statement, it did say that inflation remains elevated. And it was during the press conference and the Q&A, question and answer, that you saw the market selling off, as Chairman Powell made it very clear. One, we do not expect rate cuts, because he's always asked, well, what? This is the futures market, sir, telling us that they believe that there'll be rate cuts as early as September. And he said, well, we don't see it that way. We are holding rates as long as we can during the course of the year, right? That's what he said. He maintains that. Obviously, we don't know what is going to happen between now and then. The debt ceiling issue is still very much in play. There are still concerns about that. And perhaps, this is the market just getting a little bit ahead of itself in terms of that the Fed is going to have rate cuts as early as September. So he mentioned that. But again, he mentioned that there is still the issue of inflation. Now, when we get to this next part of my call, it has to do with the payroll report. It was strong, and interestingly, the unemployment rate came down even lower to 3.4%. Now, granted, there was a downward revision from earlier reports that perhaps suggests that it's becoming tighter and tighter in terms of availability of jobs. We know that from the JOLTS report, job opening and labor turnover, there are fewer jobs that are listed, which then actually keep people at work because you're afraid to quit. You don't know if you do get a new job, are you going to be last in, first out if there is in fact a recession. So this is important also in terms of wages. Wages have climbed higher year over year, right? That was clear from the report. And Chairman Powell mentioned that. He mentioned it in the press conference. So this is sticky. And again, why are higher wages important? Because what we know is that companies see higher wages as an input cost and therefore want to pass it along to the consumer. Have we seen that already in this earnings season? You bet we have. One company after another saying, yep, we raised prices and we did very, very well. The question becomes, at what point does the consumer say, no, not yet? The consumer, remember, we are 70% of our economy. And as long as the job market is intact, as long as the job market is resilient, what it does is it allows us, the consumer, to keep spending. There's a direct positive correlation. It's pretty practical. You don't have to be an economist to figure out the relationship between job availability and the labor market in general and consumer spending. So that's what we have. The market sold off during that press conference, again, because of a concern that, wait a minute, maybe the Fed would actually raise rates in June. I can tell you this morning, the probability for another rate hike at the June meeting is actually very low. It's below 10%. Now, there's going to be this week, we're shifting over to this week, there's going to be an awful lot of data this week. Consumer Price Index and the Producer Price Index, the PPI. Extremely important. And why? Because also what we have seen from the Institute for Supply Management, that's the ISM, that's the Purchasing Manager reports, manufacturing, it's pretty stagnant. It inched up a little bit, but prices paid moved higher. When we saw the service sector, which is the largest part of our economy, that report from the ISM, Institute for Supply Management, was above expansion, that 50 expansion level, just above it a bit. But also what we saw, that prices paid were higher. This is what the Fed does not want to see. So between the wages, between the higher prices, it's something that needs to be watched because, again, what the market is hoping for is that the Fed is really pausing. And perhaps it's a pivot, meaning it's over. It's one and done. A lot is going to depend on, again, the reports this week. Another thing that we have seen is the expectations for a stronger quarter in this second quarter have actually inched higher. The Atlanta Fed GDP now, which keep in mind is a dynamic, it changes on a regular basis. I think this week we're going to get another view of their GDP forecast for the second quarter. But right now, as I recording this call, it's at about 2.7%. Hardly an economic slowdown, right? Again, we've got a long way to go through this month. But let's keep in mind that the economy seems fairly solid, although there are cracks appearing. But as long as the labor market remains resilient, it is probably the most important thing in terms of the overall economy. You could have companies not spending much money on capital expenditures, which is what we're seeing. You could have a slowdown here, a slowdown there, but as long as that labor market remains okay, so too does the consumer. In terms of earnings, by the way, it has been fairly remarkable as we go through this earnings season, the amount of positive surprises that we have heard from companies in many different sectors, and how many companies are keeping their outlook and confirming it for the year. That's extremely good news. Overall, especially in technology, we heard from Apple. Apple came in and, revenue was down a bit. The sale of iPhones down a bit, but overall, they surprised to the upside. And that leads me to my next point about this market. It's extremely narrow in the leadership. That's why I love seeing the small caps do well, because it's been a large cap story. Large cap. Again, I go back to my words. We got to see follow through. But nonetheless, the leadership is narrow. Apple, in and of itself, is 7.1% of the S&P 500. And overall, we only have about a handful of stocks, or shall I say 2 handfuls, about 10 stocks leading the market higher. That's narrow. And then within that group, you got Apple there with 7.1%. So you want to see in a market, you want to see it expand. You want to see breadth expand. That's the indicator of a healthy market. Although, in fact, you can have a tight market with little breadth continue to climb ever higher. This week, we are also seeing the U.S. dollar weaken against other currencies. Keep in mind, this is what we call the interest rate differential. That's an economic term for you. What that means is that our central bank is easier now, right? Not necessarily leading us to another rate hike. Whereas we know that the European Central Bank will most likely come in with not just one more rate hike, but maybe a couple. They then enjoy the interest differential. When the Federal Reserve became more and more aggressive in its rate hike campaign, the U.S. dollar went parabolic. And now the landing is softer and softer. That doesn't mean that the campaign to take away the status of the U.S. dollar is gone away. No. That's active. I won't get into it in this call. They call it the weaponization of the U.S. dollar has been leveled against King dollar. But nonetheless, it remains the reserve currency. And I want to point that out because there's been an awful lot of questions about it. I do want to point out, too, that a weaker dollar does help global financial conditions. Yes, it helps countries importing the commodities priced in dollars and also exporting in U.S. dollar terms. It also helps overall easing global financial conditions, helping the S&P 500 because so many of the companies have global reach. I want to point that out. And it helps countries that have dollar-denominated debt, both in sovereign debt and commercial debt, corporate debt. It helps you service that debt much more easily. But do not equate it with the dollar collapsing. This is the normal progression when interest rates shift in interest rate expectations transition from being aggressive to much softer. Also this week, in terms of the CPI, Consumer Price Index, and the PPI, we are also going to have the University of Michigan Consumer Sentiment Report on Friday. We are going to pay very close attention to how U.S. consumers see inflation a year from now, 3 years from now, because if that climbs higher, the Fed does begin to worry, because it means that inflationary expectations are becoming entrenched. We want those numbers to be down. We want it to just be within a 2% range, not move to 3%, but be within a 2% range, because 2%, after all, is the Fed's goal to restoring price stability. So that comes on Friday, but before that, again, I'm going to say it yet again, the CPI, Consumer Price Index, and the PPI, Producer Price Index, and that is a look at the cost of production. And as I said, from the ISM report, Institute for Supply Management, the prices paid has gone higher. This week as well, we're going to hear from Disney. I pay attention to it in Disney's status as a bellwether for consumer spending. Already this week, we've heard from Six Flags. The numbers are up. They say, look, our revenue may be down a little, but consumers are spending a lot. This is important because I have to repeat this. 70% of our economy is consumer spending. So we look at these bellwether names to tell us what are they seeing in terms of consumer activity. With Disney, it's global, right? They are in Europe, they're in Asia. We want to hear what they have to say about consumer spending. It will be important because consumer spending globally accounts for quite a bit of GDP, global GDP. This week as well, we have a host of Federal Reserve speakers. Many of them are more in line with, you know what, this should be one and done, versus those who say, not so fast. We still have sticky inflation. We will watch to see what many of the financial speakers have to say, those from the Federal Reserve. Remember, they are locked in a blackout period before the Fed meets, and now they come out, right? And they'll be out until they go back in before the June meeting. So it's an awful lot for the market to absorb, but let's pay attention to the following. How do the regional banks perform this week? Is there follow through from last week? That's one. Second is, what is the inflation picture? Even though the Consumer Price Index is lagging, essentially, it's looking back, correct? We still want to see what it has to say, as well as the PPI. We also want to see what the Senior Loan Officer Survey has to say, because going back a number of months, they actually came out and said that they saw the possibility of where loan officers are becoming more careful before agreeing to issuing and allowing consumers to secure loans. So that will be important. So again, very important week for the market, still in terms of earnings, but again, important data, not to mention Fed speak. Have a very good week. We'll be back next week. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.